Hey guys, what's going on? It's Billy here from the best place to buy gold online, and hope you're having a fantastic day. So in today's video, I'm just going to talk to you about gold and its role it plays in the international monetary system. And over the last few years, gold is started to make a comeback in the world monetary system. When you look what's actually going on in the world, as opposed to the happy talk you hear on TV, it is clear that the world is already on a shadow gold standard and is moving back to a more formal gold standard, treating gold as money. We're seeing signs of that already. It's not just something that will happen in the future. The evidence that gold is moving back towards the center is clear, and it's happening for a number of reasons. The International Monetary Fund, IMF, is the third largest holder of gold in the world. Number one is the United States, number two is Germany, and number three is the IMF. It is likely that China is actually the second largest holder of gold, but its actual holdings are not publicly disclosed and impossible to confirm. The IMF plays a pivotal role in the global monetary system with far more power and influence than one might assume based on the technocratic and bureaucratic demeanour. The IMF likes to posture as a sort of benign friend to small emerging countries, but in reality it's more like a large rapacious corporation that makes a donation to charity every now and then just to show how generous they really are. The IMF was created at the Bretton Woods Conference in 1944. It took a few years to get up and running in the late 1940s and early 1950s. It started as a swing lender for wealthy countries experiencing short-term balance of payments deficits. Consider a country running a balance on payments deficit year after year. One of the ways to fix the deficit would be to cheapen its currency to make exports more competitive, but cheapening the currency wasn't allowed under the Bretton Woods fixed exchange rates. Instead, the IMF would provide a loan to tide you over while you made structural reforms to your economy. Such reforms would attempt to lower unit labour costs, improve productivity, or improve the investment climate, whatever was necessary to get the current account back towards a surplus. Once the capital account was in surplus, the swing loan from the IMF could be repaid. In extreme cases, the IMF allowed devaluation, but only after other monetary and structural solutions had been exhausted. This swing lending system broke down in the late 1960s and early 1970s when the UK steeply devalued sterling against the dollar and the US suspended gold convertibility. The fixed exchange rate system died soon afterwards. Since then, we've had floating exchange rates. After the 1980s, the IMF wandered in the wilderness for almost 20 years with an uncertain mission. In the 1980s and early 1990s, they acted as a lender to emerging markets because their original mission of stabilizing exchange rates under the Bretton Woods was gone. The IMF's reputation suffered badly in 1997 to 1998 Asia financial crisis. There was blood in the streets, and not metaphorically, there literally was. People were killed in riots in Jakarta, Indonesia, and Seoul, Korea. Many people to this day, most famously Nobel Prize winner Joel Stiglitz, attributed this financial crisis to bad advice from the IMF. By 2000, the IMF was a whale that had washed up on the shore and couldn't get back to its mission in the sea. No one quite knew what they were going to do, how they should be doing it, or how they should be doing it. By 2006, there were public calls to abolish the IMF. Then a funny thing happened on the way to abolishing the IMF. We had a global financial crisis. How convenient. And then suddenly the IMF was back in the game. It became a de facto secretariat of the G20 club and most powerful developed and emerging markets countries. The G20 acts as a kind of board of directors with the IMF as a staff and agency to implement the will of the board. The IMF has its own governing board, but interestingly, if you look at the membership by country, there's a lot of overlap with the G20 membership. The G20 member countries and the countries of the 24 members of the IMF Executive Committee are, by and large, the same. The G20 was a group of heads of state that didn't have a staff, while the IMF has ready-made staff. Since 2009, the G20 summits have worked hand in glove with IMF technical capabilities, staff and analysts. New lending facilities have become highly politicized, as seen in Ukraine and Greece. The fact is the IMF has always been a rich countries club. The IMF voting mechanism requires an 85% vote to make any significant changes, such as a change in articles, the governing document, or to approve a major lending initiative. The United States has over 16% of the votes, which means that if all the other members combined voted against the United States, it still wouldn't be enough to make anything happen. None of this is by coincidence, of course. The US has always been the largest voice in the IMF, and headquarters of the IMF are in Washington, D.C. One of the big governance issues in the world of international finance right now involves changing these voting arrangements. If you approach the issue in terms of how much your GDP as a percentage of world GDP and compare that to your IMF vote, rich countries are overweighted and emerging markets are underweighted. China is a good example. China is about 14% of global GDP, but its vote in the IMF is less than 5%. Legislation that would change this to give China a larger voice has been stuck in the US Congress since 2010. Recognition of China's rightful place in the IMF hierarchy is being held hostage by the US in exchange for China's good behaviour in the battle over currency manipulation against the US dollar. Now the IMF is back to its original mission of lending to rich countries, mostly bailing out Europe, where the overwhelming majority of its money is directed. The bulk of the IMF's money is not going to poorer countries like Botswana or Mali or Jamaica. It's going to Poland, Greece, Portugal, Ireland for political reasons. Ukraine. And for political reasons, Ukraine. This new lending spree requires new sources of funding for the IMF itself. If you're going to lend, where do you get the money to lend? Banks can take deposits, pledge assets to central banks, or create money out of thin air. The IMF doesn't have a teller window where you can make a deposit, but it does borrow the money. It issues notes. Interestingly, these notes are not denominated in dollars, they're denominated in special drawing rates, or SDRs, worth about $1.40 each as of this writing, although the SDR value fluctuates with the markets. So what is an SDR? Well, it's world money, but not the kind you carry around in your pocket. You can't go to an ATM and withdraw a bundle of SDRs, but SDRs are money, and they play an increasingly important role in global finance as the power of the dollar declines. There's actually a trading desk inside the IMF that can swap SDRs for other hard currencies. Here's a simple example of how that works. In 2009, the IMF issued a 182.7 billion of SDRs, equivalent to around $255 billion at current exchange rates. The way they issue them is in accordance with a quota, which is simply the word they use for a country's share. If I have a 5% quota at the IMF, and the IMF is issuing 100 billion SDRs, then I'm going to get 5 billion SDRs, or 5% of the total issued. Many IMF members had quotas, but didn't need the SDRs, and wanted other hard currencies instead. Hungary is a good example. Going back to the early 2000s, Hungarian banks offered customers mortgages in two currencies. They could take a loan in local currency, which is the foreign, or they could take the loan in Swiss francs provided by European banks in Vienna or Zurich that could fund the loans. Swiss franc mortgages were about 2% of the foreign mortgages. And the foreign mortgages were about 9%. So most of the borrowers took Swiss franc mortgages, assuming the exchange rate would remain fixed, but it didn't. The foreign collapsed, and suddenly the mortgage debt relative to the borrower's local income increased dramatically, and of course defaults skyrocketed. If you're Hungary and the IMF gives you SDRs, your reaction is that you need Swiss francs, so your central banks can help the local banks repay the interbank loans. Now you call the IMF trading desk and say, offer me dollars for my SDRs. The IMF desk will call their place like China and say, do you have a bid for SDRs? China says, yes, we do. China will send dollars to the IMF and get SDRs in return, and Hungary will get the dollars, sell them on the spot to buy Swiss francs, and then use the francs to help their banks. That's the way you turn your SDRs into something else if you need them. If the IMF doesn't issue SDRs except in liquidity crises. The next time there is a global liquidity crisis, it will be bigger than the capacity of the Federal Reserve and other central banks to contain. The Fed has used up its balance sheets, used up its dry powder. If you will be dealing with the last crisis, they have not been able to unwind the balance sheet, and it's unlikely that they will for a decade. The same is true for other central banks. So they have no further capacity to print money without destroying confidence. They might have some legal capacity to print more, but they are at a limit of what they can credibly do. It is in the new liquidity crisis that the world will turn to the IMF and be re-liquidified by the issuance of these SDRs. That process may work without impinging confidence because so few understand it. The massive issuance of SDRs will be highly inflationary in dollar terms, but policymakers in Washington will simply point the finger at the IMF as an unaccountable agency. One effect of a massive issuance of SDRs will be to hinder capital formation by destroying the real value of the dollar-denominated assets. The only shelter in the storm will be hard assets, including gold. Astute individual investors are positioning their portfolios that way today, and so are major powers such as Russia and China. What if people lose confidence in the IMF and the SDR solution? Who bails out the IMF? Right now, there isn't anyone. Turning to the IMF is not kicking the can down the road, it's more like kicking the can upstairs from private debt to sovereign debt to multilateral debt issued by the IMF. The IMF is the penthouse. You can't kick the can any higher. The only thing standing behind them is the 3,000 tons of gold and the gold held by the members in the US and Europe. This is why I keep returning to the subject of gold. This is why I continue to calculate gold to money ratios and gold to GDP ratios and develop dollar price projections of $10,000 per ounce, possibly higher. If confidence in national paper is lost and you try to bail out the system with a different kind of fiat money, specifically SDR, what does that do? If it works at all, it will only be for two reasons. One, almost no one understands it, and two, we won't have SDRs in our pockets. SDRs will be used by, for, and between countries, not by individuals. SDRs won't be transparent, they will exist and be highly inflationary if printed in sufficient quantities, but no one will actually see them because they are the most technical and abstract form of money ever created. If SDRs work, it will be in part because so few people understand them. Still, if people do understand, they are likely to lose confidence in that scenario. Again, the only resource that we have available is gold. So there you have it, guys. Just a little bit of information there for you on the IMF, special drawing rights, how they play it, and obviously how gold will play into the international monetary system. I hope you got value. If you did, feel free to like, comment, and share. And again, like I said, this series is all about the new case for gold, and the book written by James Rickards. And I'm just reading a quick segment for you, and I highly recommend you go ahead and get that book. There's a lot of information in there, some valuable information in there. There's a link in the description below. Go ahead and check that out, and I'll see you on the next video. Take care. Bye bye.